And it's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show. I'm Stephen Engel with this man right here, David Ingles.
Yep, it's the Engel and Engel Show again today. Happy Monday morning to all of you. We're counting down to the open of greater markets as the approach is looking like this with stocks across the region on the up as disappointing U.S. jobs data erodes the short-term case for Fed interest rate hikes. Oil extending gains with a Strait of Hormuz deal remaining elusive. Now, we'll be watching China's AI players at the open after reports that ByteDance is working on what could be the country's biggest AI model in an effort to leapfrog its rivals. And on the weekend, China's inflation print comes in much cooler than expected, reflecting easing pressure from energy shocks as well as continued weakness in the underlying economy. And Beijing joins Shanghai in easing home buying restrictions in a bid to revive the Chinese capital's sluggish property market. Good morning and welcome to the program. We're looking at a lot of different sectors today as we approach the open. So we talked about oil prices. We're looking at energy as far as that's concerned. Brent price is $84 right now. As we kick off a fresh trading week, we are, of course, also having to discount a softer U.S. dollar following the jobs report on Friday. U.S. jobs report on Friday, and certainly it does going to be fairly compelling, even more so to watch that those Treasury auctions at the back end of the week. I think we have 10 and 30-year auctions in the Treasury market. S&P futures are a touch softer. We are a touch stronger on the regional benchmark. Speaking of Fed rate hike bets, here's a two-day look at where we are in Treasury yields, and you can see, of course, quite visibly when the jobs data came out. Similar look as far as gold prices go and really being traded as a risk asset. Over 3 days, gold is at 4,400, just easing back a little bit from that level. Certainly gold stocks will be tracking going into the day today. Right, equity markets, just keep in mind Singapore is on holiday. You do have a couple of markets, of course, coming online like Malaysia. Taiwan, as you can see on your screens, better by about 1.4%. Nikkei, 1.3%. So we are just over the hump in as far as earnings in Japan are concerned. And we go into the thick of things as far as Greater China, as far as results are concerned. Right, A50 futures coming up on your screens. Dollar China, it's going to be critical given the dollar weakness we've seen. And do we get pushback, I guess, is a question right now for FX markets from officials. They're given how strong we are now in the Chinese currency. But relatively speaking, of course, it's been strong really across the Asian FX board. Right, 2, 5, 10, and 30 on CGB on the back of really much softer inflation numbers coming out on the weekend. We'll talk more about this in a moment, but the statistic for you, it matched the biggest miss relative to estimates. I'm talking about consumer prices going back about 3 years or so. So 0.5% was headline inflation. Of course, we'll talk about PPI in a moment, but as you can see, bonds just about across the board, with the exception of the short end, are seeing a bit of a pullback right now. So we are stronger yet again on Chinese bond markets.
Yeah, and Dave, no surprise, this Monday morning, tech is at the top of our agenda. Yep. ByteDance has reportedly told its employees that it would not use distillation as a shortcut to advance its AI models, even if it means lagging behind domestic rivals. That's according to the information. Let's bring in our China correspondent, Min Lo. So how should we read this? They're not going to be using distillation, which was one of the criticisms of Moonshot AI, that they had been distilling from the large language models in the United States. But we're also hearing that they're aiming to have a pretty big model with high parameters to develop their AI over the long term.
That's right, Steve. And this is according to the information's reporting. It's pretty remarkable and worth noting just because not many Chinese companies have publicly addressed the issue of distillation. But according to the information, Zhang Yiming, who is the founder of ByteDance, had told its employees in an internal meeting that the company will not rely on distillation for any advancements of its AI models, even if it means lagging behind. And he says this is because the company must be willing to sacrifice short-term gains for long-term goals and and distillation is going to interfere with true indigenous long-term tech innovation. And it also speaks to the ambition of ByteDance because, as you said, they are planning to work on this 5 trillion parameter model. And to give you context, Kimi K3, which is currently the largest, has 2.8 trillion. So ByteDance is aiming for 5 trillion, which is way above what is currently available. And they are planning to use that to leapfrog competitors. But of course, this is according to what reports are saying. Some are saying that this is a project that is in its early stage. It may or may not pan out. But again, it comes after Kimi K3 really shocked the tech world with a much smaller company, much fewer resources than ByteDance, being able to create a model that is on par with frontier models. That really started off this internal debate about whether or not to use distillation.
I mean, speaking of the breakthroughs we've seen, and this could yet be another one, of course, if they push through with it. We're hearing from sources that the U.S. is looking at how China's firms are able to get access to certain NVIDIA chips overseas. Just give us the context and what is it exactly?
Yeah, so this is a Bloomberg scoop by one of our colleagues. According to sources, she's found that the U.S., under the Department of Commerce, there is a U.S. agency that is now investigating how Chinese companies are getting their hands on these NVIDIA chips. So they're compiling a list of companies that are allegedly having these black market operations to get the chips to China, and they're compiling a separate list of countries that are offering access to NVIDIA servers through these cloud computing agreements. Now, these are technically legal. You can rent a server overseas, and that doesn't violate U.S. export controls. But the question is, as they compile this list, does this mean that the U.S. is starting to make the preliminary steps to tighten that loophole? And the question is also whether that U.S. agency has that authority, because it's able to limit the movement of physical goods. But whether it can really stop these cloud computing agreements, that's a different question. And legislators are trying to give it that authority. That bill has to pass through the Senate. And then the next level of opposition could come from, of course, the U.S. tech companies, right? NVIDIA has been very opposed to these export controls, saying it's already cutting off access to the second largest market in the world. And he's saying the U.S. cannot afford to lose Asia because a lot of the data centers cropping up in Asia is driven by demand from these Chinese firms that are renting the data centers.
Okay. Min Min, thank you so much. Min Min Lo, with a recap there of the big tech stories that we're tracking going into the open day could have, of course, some implications as far as market reaction is concerned. Now, just very briefly, we talked about this inflation print, which came through very soft. And, you know, the bond markets are, in fact, somewhat reflecting, this, of course, isn't an overnight phenomenon in China. There has been, of course, very soft inflation. But in terms of the line in the sand, the Chinese 10-year yield now appears to have taken out the 1.7% handle to the downside. We are getting this bond market rally as, of course, it is the softer inflation print just about across the board.
I mean, it really speaks to the fact that, of course, we all know there's energy inflation across the board. There's inflation, as reflected in PPI and the factory gate, on AI equipment that has been priced higher. But that just shows that there is not much pricing traction in the broader economy right now. When you have CPI at just 0.5%, we were expecting 0.8%. It was 1% in June. So still very, very extremely tame inflation right now. But at the factory gate, which has been, in the last 6 months, it's turned the corner from 41 straight months of deflation. Now at 3.5%, we were expecting 3.9. June was 4.1. So it's losing a little steam as well at the factory gate.
Yeah, I think you alluded to this very nicely with the energy shock, somewhat being discounted away at 3.5%. And I think interesting is you strip out the sort of effects of energy price inflation and what you have in the Middle East, is what are you left with when you look at the Chinese economy and at the end in terms of demand there. And I think it's quite telling when you look at the data that's come through in the last, let's call it, week and a half, including PMI numbers and the export numbers. It paints the same picture where exports seem to be the only major component that's doing well.
Right.
But the forward indicators on PMIs, which missed just about across the board in July, does seem to indicate we've sort of seen a softer turn in the data.
Yeah, and you have to also look at, is involution still strong. The price wars across many of those exports products as well. The price wars has spread across a number of different products and industries. So that's something the government's trying to work on. When you have 0.5%, which a central bank probably doesn't mind too bad. I mean, inflation is the big...
that's true.
The big challenging point usually for central banks. But now we're getting down towards deflation on CPI.
HSBC will be joining us later on to talk us through what where they think policy should be. The reason I think HSBC is relevant is they were one of the very few banks that actually got this specific inflation print on consumer prices bang in line with expectations. So is there a policy prescription here more than what we've already talked about, more than what the Politburo had already guided and laid out for us there? So obviously stay tuned for this interview coming up at those times on your screens there.
But first, we're speaking with Citi's head of global equity strategy, Beata Manthey, on why she thinks, or still likes, I should say, tech, even as we see signs of broadening. And we're also counting down to the open of trade in Shanghai, Shenzhen, and here in Hong Kong. That, of course, is Hong Kong. That's Wan Chai, the convention center, and this is the China Show.
Okay, so going into the jobs report on Friday, it did seem non-material, turned out to be the opposite. Obviously, very soft jobs report. As you can see, we've repriced, the markets have repriced, of course, the expectations around the September meeting from what seemed to be base case to now 43% probability of still an interest rate hike. Markets have taken this in stride. As you can see, equity markets across the region are doing quite well. S&P futures a touch softer. But I think it's also worth pointing out that all of this against a backdrop of decent earnings, a broadening out of the tech rally, and not on your screens, but fairly consequential, is a VIX index that is pretty much at the lowest level of the year at about, I think that's a 14 handle. And as far as that's concerned, so does that actually bode well for equity markets going into? So it's August already. The last couple of months here, 2026. Joining us here on set is Beata Manthey, head of global equity strategy at Citi. Very nice to see you. Good morning.
Likewise, morning.
Thank you for coming into the region and paying us a visit. Equity markets have done well up until this point on an index level. Do you think that remains the case over the next few months?
We do. We remain constructive, but it is ever-evolving equity market, right? So a few months ago, we had this very narrow leadership that it was all right for the index level. However, not many parts of the market have done well as the tech and AI leadership has really crowded out everything else. And we see it changing going forward. For the last few weeks, you already had a sense of that. So the broadening has started. The question is, can it continue? Right. And for that, you need some sense of macroeconomic stability. So for that, we look at the Citi economic surprise indices. They are picking up everywhere, especially in the cyclical markets. Of course, they went lower through the war, right? Now, as the situation is improving, they are improving. Earnings revision, so the direction of the analyst forecast, this is improving meaningfully. So there are quite an odd or unusual things happening in that measure. So it's super broad. It's been positive for quite some time because tech and energy have been upgrades have been so strong that the measure was strong, right? But now it's broadening again. So we see more sectors positively contributing, and also in Europe, in the US, in the pre-reporting season, usually you have downgrades. We are seeing upgrades now. So it's a good setup for that broadening to continue.
Are we going to need to see a pullback in the big tech, though, to allow, as a catalyst, to allow that broadening to happen?
Haven't we already seen that?
Well, we have.
Right? We've seen a bit of it
as well.
True, absolutely.
Relatively speaking.
Relatively speaking. So the way we see it, we've had a bit of pullback because tech was such a heavy overweight that there was no space for anything else. And as we move into this broadening phase, some space needs to be given up for other cyclical bits of the market. So tech has to come off with the weight. We would argue it's already come off substantially, but it's not moving completely away from tech. Tech becomes part of this broadening, right? So the investments in AI actually allow us to start thinking about AI adoption and the broader set of sectors or countries, regions that feed into that adoption. So a more abrupt giving way of tech would take the market down as well, right? So probably we are in a soft spot right now, and we do see, I've mentioned all these positive indicators for the rest of the market. However, tech is on the top of it, right? It's still a leader, but not the leader by that far. It's a leader by that far.
Well, within tech, I think we've seen the softening of large cap tech, but I think, so in terms of market leadership, so when you look at AI, people want to figure out which component of AI leads the rally moving forward. So we've gone from hyperscalers, semis to hyperscalers, back to semis, and it's now the component, memory. Do we get energy? So how do you look at that sort of more nuanced trade within the AI
Absolutely,
basket?
and that's the most difficult question, right? Because the AI trade is ever evolving, and we measure that there have been six waves of 6 phases of that AI trade already, and of course, as we move away. Or not completely move away or take the weight off, right, of the memory, then we are thinking more about the adoption or the broader set of the regions actually feeding into that trade. So tech is an overweight. Communication services where hyperscalers are an underweight, and a few weeks ago within our emerging market portfolio, emerging markets in global portfolio are a neutral, but within that a few weeks ago we've swapped our long 1 year overweight in Korea and swapped it with China actually.
Well,
that's a sign of that broadening, right?
Okay.
Because when Korea was going up so much a day, there was really no space for anybody else.
Well, that's what my next question was about. What is your top line on China right now? Obviously, tech leads the agenda almost every single day. It's leading the cavalcade of listings here in Hong Kong. Is it? I guess how much more legs does it have here in China, the AI trade, and where again?
Absolutely. When you look at the index, it's still quite subdued year to date versus the rest. So it was truly one of the bigger laggards within the space. So there is definitely more upside to come. Eventually, of course, they underperform. China has underperformed because the margins and earnings revisions were moving down, right? So as Korea was moving up and we've been seeing upgrades after upgrades, weeks after week, the opposite was happening for China. Right now we see stabilization of that. I don't see meaningful upgrades yet. However, if they pick up, then you have a completely different story and a more bullish longer term or medium term picture to invest in China. For now, there is still a question mark whether it's going to come through. For now, it's just a price reaction and repricing of very negative investor sentiment, right, and positioning.
It seems to be a macro question now, whether the macro improves in China. I think you mentioned the Citi surprise indices, and it's almost everywhere but China where you are getting the positive revisions higher. So I guess my question is, do you need to see the macro improve for China's now overweight with EM, but EM is now still neutral? What would it take for you to then bump up EM into overweight?
Well, we would really need to see some kind of boost to the consumer, right? Okay. So if AI drives the index, you don't need consumer to follow through. But if you want the proper, broader index leadership, you need this to come through.
What's your overall take on the negative impacts really have not hurt the S&P 500 of the war? Obviously, the price of oil has fluctuated, but it hasn't really stayed above $100 a barrel for a long period of time. Why do you think that is? Why are the markets, when the S&P last week hitting a new record high, is sort of discounting the impact of the war?
So when it comes to the U.S. market, of course, it discounts less because the U.S. economy is not that exposed, right? It's net exporter, actually, so it has its own energy independence. And it's the AI, when you look at the index weight of the S&P, it's really the tech that drives it. So last week was nothing about the war, nothing about the oil. It was just the market waking up to the idea, oh, perhaps we priced down the tech a bit too much, and we are seeing an amazing reporting season again. Yeah. And things are getting cheaper versus the rest of the world, versus their own history. So they are looking again a bit more attractive, right? So it's more about that. Well, when we have this true broadening, if it was away from tech, then the US it would still do well, but it would underperform more cyclical markets. We are not in that point yet. It's a bit of a combination, tech with cyclicality, right?
And do you think that's what's behind volatility, for example? The VIX is at 14, 15. Is that a very good indicator? Like, unless that kicks off, do you think that's a very good leading indicator that stocks are the place to be?
Well, you have to think, for me, from medium-term perspective, you really need to think about this macroeconomic / fundamental backdrop. I would add Fed to that backdrop. So sure. Pricing out a bit of this Fed hawkishness is also a good thing. Probably this is more important. On volatility, of course, it's great on the index level, but we know that it's a bit of a cover-up because the single stock volatility is very strong, right? Yeah. And we are seeing it in the reporting season where actually single stock reaction to their reports is one of the highest in quite a few years now. So underneath the hood, this volatility just persists. It's not necessarily even this type of single stock volatility. It's not necessarily bad for the stock market performance, but it puts a bar a bit higher, more demanding, right?
Sure. I guess it is reflective of the overall valuation. Yeah,
Beata, it's great having you here in person here in Hong Kong.
Likewise.
Thank
you.
Don't be a stranger. Come back.
Yes.
Beata Manthey, of course, from Citi. Coming up after the break, no, we're going to check the markets right now, right? Is that what we're doing, guys? Yes, there we go.
There we go. Very briefly.
Very briefly. I can't read that, Dave. You're going to have to use your eyes.
Yeah, okay.
The Hang Seng, there it is.
Font size 2.5.
Font size, I have 60-year-old eyes, so can't see it. But as you can see, it's looking like a positive day. Green on your screen as we head towards 9:30 here in Hong Kong. We'll be right back. This is Bloomberg.
Okay, we are headed into the open today. Gap higher slightly on Hang Seng Index. Within the tech space, of course, we're looking at that very closely. Tencent is on deck this week as far as earnings go, and I think you have Lenovo Thursday and Manthey on Friday. Quite fitting, of course, as we go into the weekend. Okay, well, speaking of chips and tech, so we're looking at Zhipu here getting a bump up in as far as Morgan Stanley's price target is concerned. And, of course, some of the broader reads have given, of course, the news on ByteDance, and quite a substantial in scale there, and as far as what they're looking at in their lab could be released, could not be, very early stages there. Right, Beijing-related developers on the back of Beijing easing home buying restrictions for, I think it's non-residents. That's coming up on your screens, and Wuxi Aptic, of course, bit of relief there coming out of the stock, and of course the news flow there. Coming up on your screens very shortly, the company, of course, came out last week, was in the news 3% to the upside. The opening bell, 3 minutes away. You're watching The China Show. Good Monday morning and welcome back to watching The China Show, cutting down to the Monday open there, and it was a proper, let's put it this way, Sunday really lived up to its name here in Hong Kong with the hottest, single hottest day going as far as records were kept going back to 84. Yeah, so it was
quite miserable.
A bit of a piper.
It was not a hiking weekend.
No, it was one for the AC, a couch and
absolutely.
Yeah.
Well, let's check the boards here and see whether Hong Kong is going to start off to a hot start this morning or not. Set to open up in about 9 seconds. as we, of course, are looking at a number of different tech stories.
Sure.
Also, gold companies, gold miners, as the price of gold goes shooting up again. There we go. Market open in China and in Hong Kong. The CSI 300 up just fractionally, and the Chinext as well, up about 1/3 leading the gains for the China markets. Again, we're going to be looking at more threads. Plans to list in Hong Kong at an appropriate time, according to reports and according to the company. Shares in Shanghai are up 420% since their IPO last year. Also reported first half net loss, but also revenue was up 147% in the first half. So more threads. Again, Dave is leading the way in the AI hardware space. Can we see the Hong Kong market as it's opening up as well as we've...
Yeah, can we flip the page, please?
There we go.
Yeah, like to your point, right? Really opening up, not exactly searing.
0.5% up.
Yeah.
Tech stocks, again, leading the way, up nearly 1% in the early going, and the MSCI China up 0.6% in the opening going. You're seeing, though, some of those tech names, Baidu, Alibaba, Tencent, those are the old stalwarts in tech, and Xiaomi as well, all advancing in the early going this Monday morning.
Yeah, a lot of tech strands to tell you about, and I think Steve pointed these out, right? We're looking at more threads, of course. This is the mainland listing on your screens, really on the back of this Hong Kong listing that's coming up. And, who is not listing in Hong Kong, I think, is the other question there. Of course, this is just adding to the pipeline there. Gold mining stocks, in case you missed that, yes, we've gone from just 4,000 2 weeks back on gold to now 4,400. We're pulling back a little bit from that level. But yes, we have seen a substantial pickup in momentum in gold prices. Not just gold. Silver's actually done better than gold over the last 5 days. Just keep that in mind. Right. Just in terms of all those things, right? So a couple of sectors we're tracking. We mentioned gold miners. We'll get to that in a moment. And gold, where we are in momentum. Tech, we're looking at earnings, of course, is an extremely big theme. As we turn the page from Japan, which was extremely busy last week, as we turn the page towards mainland China, and as you can see, Tencent comes out on Wednesday, then it's Lenovo, MTR on Thursday, Jingdong is also coming out, and of course you have Manthey and Zijin coming out on Friday. It's Hello Kitty Monday, by the way, in case you're a fan of that. Now, that's just to say, when you look at as a percentage of market cap, the next 3 weeks will show about 90%. So virtually the index is reporting earnings over the next 3 weeks. So it's obviously we're going to be unpacking a lot of these earnings coming through, starting, of course, with, as we were just pointing out, Tencent on Wednesday, and what the spending actually looks like, right? Right. From this, let's have a look at precious metals, something I'm tracking, of course. In case you missed that, having its moment in the sun after that, it's called collapse in momentum that we saw at the start of the year. It's really been traded as a risk asset. It struggled to regain momentum. It struggled. This is a 14-day RSI of the Bloomberg Precious Metals Index. So it's a study of momentum, not the price itself. And as you can see, we've seen an early breakout. Again, it's very early days when you look at this, but it's certainly, if you're a bull on this side of the trade, it does bode well that you are finally seeing this breakout above 60. If you like moving averages, I think silver and gold are both trading right now above the 50-day. So something to track. So we've talked about gold mining stocks, tech. I think brokers are also going to be very much in focus here, following news around, I think market restrictions, Steve.
Yeah, well, Chinese brokerages are tightening scrutiny on new accounts, David, and stepping up reviews as regulators move to curb overly risky bets. Now, Bloomberg Finance editor Adam Hay is joining us. Adam, how do we need to read into this? Because there have been a number of regulatory crackdowns on insurance companies. And in June, we saw, of course, banks here in Hong Kong, putting extra scrutiny on new account openings, wealth management, and the outflows from China have been under scrutiny. How should we be reading this latest news?
Yeah, Steve, great story, great reporting from some of our colleagues here on really, lifting the lid on what some of these brokers are doing. And I think the way to think about it is just this level of scrutiny now, really building on pretty much any borrowed money, any leverage that you're seeing with brokers. So that could be margin lending, that is definitely related to options trading, and of course securities lending as well. So just these different elements of the way that people are able to borrow money to speculate speculating the market, essentially. And we do know that brokers, including Citi Securities and also East Money Information, are kind of some of the names that are involved in this. So clearly, it's a notching, a ratcheting up of the information that the authorities are looking for to try and get a handle on, the areas of concern that are, of course, been well flagged and a big driver of the market, where leverage has been, in some people's opinion, going a little bit too far, and the need to kind of rein some of this back in.
Adam, David here. You don't need to look too far to see perhaps what they do want to avoid. I mean, I'm alluding to Korea, for example, and some of the efforts there to rein in, leverage. One statistic, not on Korea, but the trading boom we're seeing in China that stood out to me from the story here. CICC estimates that the 42 listed brokers are actually set to report 50% pop in profits, which I think underscores then this trading boom that we're seeing. So, Adam, how does that backdrop feed into broader efforts from authorities to, let's call it, develop the capital markets more sustainably longer term?
Well, that's it, isn't it, David, really? You're speaking to the balance here that the authorities are trying to grapple with. So sure, on the one hand, you are seeing this big driver of retail flows, a key area of the market. And as you said, not just in China, but of course, this year very clearly in places like Korea and Taiwan as well. And so you're trying to kind of keep that speculative interest in the market, which is, of course, a totally fine thing to be doing as long as it's in a controlled, doesn't run away. But then the authorities, on the other hand, of course, have this long-term plan that's been in place for a long time to really develop and open up incrementally capital markets. So it is a fine balance for them. It's a fine judgment call to say how long things can run before you start to weigh them in, but clearly a ratcheting up here of the scrutiny, and that's really feeding through to the brokerage community as we're seeing it and reporting today.
Adam, fantastic. Thank you, Adam Haig, there, our finance editor in Sydney, for his really good reporting there from our colleagues there. From one sector, we're tracking to another related, of course, which is financials here. So Beijing is loosening its home buying limit to boost its property market. The city has reduced the home purchase requirement on social security contributions, or these individual income tax payments, to 1 year for households not registered in the city. So these are aimed effectively to just simplify the concept for non-residents to participate in the market. Let's bring in Bloomberg Intelligence. Sorry, we buried the lead there. Christy Hung is here with us on set to talk us through this. So Christy, they last, I think, moved late last year in Beijing. With the latest measures, do you think this is finally going to help the market turn?
Right. I think it's important to note that the new home inventory in Beijing is sufficient to cover 30 months of sales. So in context, to get to equilibrium, we need 8 to 14 months of sales of supply. So I think we still have a big gap there. And what we're seeing here is that for us to have these kind of stimulus measures, it usually produce a short-lived policy-induced recovery in the market. But for us to get to an equilibrium, our model suggests that, for Tier 1 cities in China, it would take us at least until mid-2028.
Okay, so we're deeper into that, another 2 years. We're already 4 years deep into this downturn in the Chinese property market. But we're starting to see in Hong Kong a bit of a pickup in the residential market. Is there any correlation between what we're seeing here in Hong Kong and what possibly could be in the pipeline for Tier 1 cities like Shanghai and Beijing?
Right. I think the Hong Kong market offers a very different set of fundamentals. If you look at supply-demand dynamic, new home supply in Hong Kong has been on average around 12 months. We were talking about 30 months for Beijing earlier. And Hong Kong, the government has very strong discipline in land sales, and we have the fiscal reserves to support that. And it also, offers that kind of currency diversification for mainland buyers, as well as the fact that in Hong Kong, we have higher rental yields and therefore positive carry. So I think Hong Kong market has a very different set of conditions to support our recovery compared to Tier 1 cities in China.
I mean, the math just works in terms of incentives, right? In terms of renters versus buyers. Now, broadly, do we expect more support in Tier 1 cities to come through now?
Right, so we had already seen a fair amount in 2026, and you are seeing, in Beijing is lowering non-resident home purchase requirement to just 1 year of tax or social insurance proof. The thing is, the more we're relaxing, it also means that less policy ammunition we'll get. And in a sense that if we are going to take a few more years to get to a housing bottom, what more policy tools does the government have in its toolbox?
Policy fatigue, some would say, right? A little bit.
Well, I think we've been talking about this story for several years
We
now,
have.
right?
All right, Bloomberg intelligence analyst Christy Hung, thanks so much for keeping us up to date on the property sector in China. Well, coming up, President Trump touts $3 billion in critical minerals project in a bid to counter China's dominance of supply chains. Details of that coming up next. This is Bloomberg. You're watching The China Show.
Right. Well, welcome back. Let's talk about the latest here coming out of the U.S. president and as far as what they're doing to, I guess, reduce their dependence in terms of critical materials to mainland China, for example. So I think what President Trump is touting right now, investments worth than $3 billion into exactly that, critical minerals there, aimed at then weaning the U.S. off this China-dominated supply chain across the world. Jill Deeses, our managing editor, is here to talk us through what he's saying and how much progress we've seen tangibly in as far as this is concerned.
Right. Morning, David. So, look, this is an addition already to about $10 billion or so that the U.S. has already pledged going back about a year to really kind of trying to speed up its adoption of, all of these different, ways in order to get more critical minerals, because as we know, China has absolute dominance in this field. And it's been a pretty big source of tension between these two countries, even despite some efforts last year to facilitate a trade truce that allows for more free movement of a lot of this type of supplies. Contained within this latest $3 billion announcement, you've got, various measures to try to increase the ability to expand production of lithium-ion battery cells, other parts connected to silicon batteries. So you've got a ton of different measures that the U.S. is ultimately taking here. Again, a really tall hill to climb for the U.S. to try to catch up here. So we'll have to see how much this actually ends up helping them with that kind of progress.
And they need a lot of long runway to do this. These kind of mines and this kind of exploration takes years, if not decades.
Yes, Steve, I think, safe to say the U.S. is certainly playing catch-up here, and that's, I think, probably, a massive understatement. Yeah. When you've got the kind of dominance that China has in this field, it's no surprise that the U.S. and others might want to try to reduce their reliance on China to obtain critical minerals, but again, it's going to take a massive amount of investment. The other thing, too, so there's a component of this plan that Trump just announced that contains some education for people for mining schools. Obviously, an industry in the United States that has, fell into decline for decades at this point. So certainly a lot of challenges here. I think the other thing, though, to really keep in mind here is this announcement comes just about a month or so before the U.S. president and Xi Jinping are due to meet in Washington, D.C. So a little bit of a, is this a shot across the bow? I think that there's a couple of different ways to interpret that, but it's kind of interesting timing here just with this sort of announcement.
Jill, thank you so much. Jill Deeses, our managing editor there. That's ahead, of course, of that big meeting, which is slated for about 6 weeks' time. Of course, late-ish September. Okay, back to the here. Now, more threads planning a Hong Kong listing. Shares on your screens, A shares to be more specific, should be at session lows now, 581 a pop there on the stock price. This is the A shares, as we were pointing out on the back of. There we go. Thank you so much. Just so our viewers have a visual of this talking head. Okay, from that, of course, let's take it now to the broader conversations around, yet another AI-related company coming to market, raising some money. You have, of course, the big one recently, which was CXMT, that blockbuster debut, to surging chip sales, Cambricon, more threads, we discussed that. And this broader AI push in China really gaining momentum as Beijing channels capital and demand toward homegrown tech, and that push is the focus of today's Big Take. We're joined here on set by our Bloomberg Asia equities reporter, Winnie Xu, to talk us through the positive picture here, question mark for China's chip makers.
Yeah, so far we're seeing pretty positive earnings results, right? As this earnings season really start to take steam. We are looking at Campicom, for example, seeing the first half sales pretty much doubling from what we saw compared to a year ago. And similarly, more threads you just mentioned, also expecting revenue for the same period of time to jump as much as 150%. And really, that goes to show how the Beijing government is really pushing for that tech self-sufficiency, especially when they really don't have much access to the most advanced chips from NVIDIA. And this is most likely going to accelerate even further because we just had that survey from Bloomberg Intelligence pointing to how Chinese chip makers and these Chinese tech companies expecting about 50% of their AI accelerated budget to go into buying local chips in the next 12 months. Versus about 30% right now. And Morgan Stanley also expecting about 70% of that AI sufficiency level being reached by China in the next decade versus about 30% or so right now. So you really see how that push for tech self-sufficiency to kind of take on the U.S.'s dominance in the AI race to pick up.
Well, I find it interesting because we've been covering it every single day, and the IPO pipeline really growing and really dominated by hardware players and also large language models here and the AI play. But at the same time, you're also getting regulation to kind of, clamp down on speculative plays. It was one of the Bloomberg stories today with brokers, brokerages getting more scrutiny and kind of reviewing new accounts and also the outbound flows of money that a lot of them have gone into these IPOs. So how do regulators in China, through this Big Take article, kind of balance the need for that capital, but at the same time curb that kind of speculative play?
Yeah, so what they really need is a stable market that they can really tap onto. And what's so interesting this time around is how, we've known for a long time that the U.S. has been doing this, tapping onto capital markets for that push for tech. And China is really just catching up now. And that is coming as they now see how the tech sector is strategically important for China's economic growth and also its when it comes to its military advantage. So it used to be Beijing's tax incentives or even subsidies, but right now you're seeing that shift into tapping onto capital markets, and you're seeing, for example, that big IPO from CXMT as well as regulators coming in to stabilize the market ahead of that IPO. And then on the bond side of things, we're also hearing regulators telling banks that they should be able to provide some of these stabilizing financing for the companies that want to raise money. And that's probably why we're also seeing that funding costs for these Chinese companies have been really cheap, and in fact is the widest gap between U.S. and China since 2016.
Okay, so what's the broader market implication of this shift?
Yeah, it's actually pretty symbolic. I'm not sure if you've really realized how until now, we're really seeing financials being the biggest weighting when it comes to CSI 300. But right now, it's actually tech. So investors are seeing this being a structural signal that Chinese capital market is really shifting to more tech-heavy. And especially with CXMT becoming the biggest, most valuable company in the onshore stock market. And when it comes to the implication for fund flows, we're seeing investors rotating away from the traditional sectors, whether it is properties or consumers, and shifting into these tech companies. And that's probably also why we're seeing the chip-heavy Star 50 up some 27% so far this year, and in fact hit a record high in June versus CSI 300 overall flat.
Yeah, that's a good point. I think this time in 2025, the biggest stock by weighting on the CSI 300 was a company that's reporting on Friday, which is Manthey. You fast forward to today, and that list actually it's CATL, and I think it's Zhongji Inolite. I think is the two heaviest weight. How quickly things have shifted. Okay, Winnie, fantastic. Thank you so much. You can check that out, of course, on the Bloomberg terminal. And if you have an internet connection, and hopefully you do, you can check that out also on the internet, on the website. Okay, a brief look at markets. We're doing well across the Asia Pacific. Flat on S&P futures. Same on the opposite side of European stock futures. We're outperforming broadly on MSCI China relative to other markets in the Asia Pacific this Monday. Lots more ahead. This is Bloomberg. Welcome back. Here are some corporate stories we are following. The U.S. is accusing China of using dubious pretexts, plural, to press its disputed territorial claims in the South China Sea. That's after Beijing announced new rules for a nature reserve at the Scarborough Shoal last week, barring Filipino fishermen from the contested waters. Now, the U.S. State Department has called the move destabilizing for the broader Indo-Pacific region. Now, the Pentagon is pressing major defense firms to speed up production of key weapons and missile defense systems. And Deputy Defense Secretary Steve Feinberg also asked companies to submit plans by late August for faster deliveries and increased production capacity. Now, concerns are rising about U.S. weapon stockpiles after the operations against Iran. Now, President Trump, however, has denied the U.S. is running low on munitions. The U.S. Senate has passed a short-term spending bill to avert a government shutdown, sidestepping Trump's calls for emergency Iran war funding and new voter ID measures. The bill would keep the government funded through December 11th and now heads to the House, where lawmakers are expected to take it up later this month. Okay, we're about nearly half an hour into the trading session here. We're about more than that in as far as CGB cash markets are concerned here. We're tracking this very closely given the downdraft we're seeing on inflation pressures. And, of course, as you can see, we are testing the low ends of the recent ranges here, 1.7%, let's call it that, on the Chinese 10-year yield. Apart from that, benchmarks are looking like this. In fact, we are doing actually okay, relatively speaking. We did give up, though, that I think it was a 4 or 5 week streak of outperformance, MSCI China over peers globally last week. We are starting off the week well on decent footing relative to what we're seeing across the region, 0.9%. We do have a ton of Chinese companies reporting this week. We've talked about this with the likes of Tencent, which we'll talk about later on in the show. Speaking of, the second hour of the China show is just ahead. Welcome back. You're watching the China Show. Here's a look at for one, the convention center, if you're viewing it from the perspective of Kowloon. We are coming off quite a fun day, Sunday fun day, if you will, really living up to its name there, following scorching temperatures there. So don't let the optics fool you. It is boiling out there. In case you have a bag day ticket to Burning Man, simply step outside. There we go. Hang Seng Index, 0.7% to the upside. We are getting a lift across quite unexpected drivers today. So it's not so much about the large cap platform names in mainland China. So gold is doing very well following the run-up we've seen in recent days. Laupu Gold leading that up 1%. Wuxi Aptec news flow has been decent and supportive. And Zhipu is getting an upgrade here from Morgan Stanley as far as the price target is concerned. And perhaps Min will talk more about the sort of underlying fundamental story on AI in a moment here. Benchmarks, Nikkei, last 30 minutes in the morning session, final 30 minutes there going into the break. KOSPI has lost a lot of the momentum in the early goings. Taiwan, though, is doing very well, up about 2.2%. Bond markets, okay, two stories, perhaps more deflationary. The jobs data on Friday and very soft inflation numbers on the weekend coming through out of mainland China. We're mixed, but as you can see, the 10-year yield in China is pushing towards 1.7. I think we have bond auctions later this week in the Treasury market, 10 and 30, latter part of the week. Keep an eye on that. Aussie 10-year. Oh, I almost forgot. It's the RBA tomorrow, and guess what? They're not expected to do anything. So that's as much time as I'll spend on that story for now until they tell us otherwise. Okay. Let's talk about the equity markets and what we're looking at as far as sector groups are concerned. Anthony Stephens is here with us, our markets reporter, to talk us through tech and the AI capex trade, how that's playing. And Korea's not participating in that
Yeah,
today.
that's one of the more interesting things, right? You're seeing quite a strong day from the Nikkei, quite a strong day from Taiwan, and Korea is lagging. And there's a lot of moving parts to that story. So the first part is in the U.S. overnight session, you had a lot of bullishness around go-forward investments in tech. So the U.S. hyperscalers have come back. Their AI plans have been kind of validated, and now SpaceX has been added to that mix, right? So SpaceX traded very strongly on Friday, and one of the reasons for that is kind of U.S. and tech-specific reporting around the fact that their AI capex is sustainable. They can find the money to do that. They can rent the compute. So all these kind of Taiwanese and Japan picks and shovels trades are back on now. Everything's up around 5 to 6%. The second data point that came out of the US is that NVIDIA has started to invest directly in data center power solutions. So we had the information reporting on that, and that's taken a lot of the names in that space in Taiwan close to limit up. So the server space in Taiwan is close to limit up. TSMC is doing reasonably well, and that market is rock solid. So what is ailing Korea, right? Korea, it seems to have a crisis of confidence amongst its retail investors that are starting to ask, where is all this cash that Samsung and Hynix are producing? Why is it not being returned back to shareholders? And there is this kind of narrative problem now where Samsung and Hynix continue to invest in new capacity. They're under pressure to also return some of that cash back to shareholders. Otherwise, there's a risk that you continue this like cyclical pattern of the Korean semis where they make a lot of money, but then they put that money into capex, and that money is not returned to shareholders. So you're seeing that kind of concern versus demand versus supply of shares and of cash flow play out in Japan and Taiwan, beating out Korea here.
I mean, just to mention, we're getting this line coming out of the Nikkei on Anthony's point right now on increasing capacity. So Sony and TSMC are to invest $1 trillion in a sensor plant in Kumamoto. Obviously, we'll have a look at more details as far as that's concerned once we have more information on that. One market that is coming online this hour is Jakarta. That's coming up on your screens. The reason we're bringing that up is we are now set for a technical bull market. So that's 20% up from a recent low. Let me just bring that up on my screens, what we're doing on the JCI. We're now looking at 1,000 points from that moment in time back in early June. So we're now trading at, what, 60, let's call it 6,500. We're up 0.6% currently, so just managing to just push us over that line. Now, Anthony, sorry to interrupt. Now, the China story and LLMs, their token prices continue to fall. The broader adoption of Chinese tokens was one where that sort of fueled the bullish case. How are we looking at that sort of dynamic now?
Yeah, so it's looking like China's going to get some benefit out of its adoption push, right? So these token prices coming down, they do have LLMs that are priced at the bottom end of the curve, but people are using them. So in terms of market share, China is gaining. But also what's kind of been slowly forgotten is China's big hyperscalers get to use these cheap tokens, right?
Yeah.
Their profit margin on lending out cloud, they're lending out software, they have super apps that are using AI, those suddenly have a much lower cost base because of the innovations made in other parts of the ecosystem. So China's kind of open source AI ecosystem at a lower token cost is helping its entire software industry. As a result, we are seeing this kind of HS tech slow grind higher. Now remember, that is one of the big underweight globally in tech. It hasn't done anything for a long time. It's still down 10% year to date, and it's just above now the moving averages. So this is a very uncomfortable, slow, boiling underweight, right? And it's absorbing a lot of flow. If you guys have been covering it, right? There's a lot of new listings. There's a lot of secondary listings. There's a lot of share placements. Jerpo and Minimax alone is over $2 billion. And yet the market is grinding higher. So there is a lot of capacity to take risk here under the hood to play the China ecosystem as it catches up to the US. And that's something that bears watching in the back end of the year because the volatility around HS Tech is materially lower than what we saw in Korea. So this steady grind is probably going to attract some incremental eyeballs in the second half of the year.
As slow a burn as it is possible. Anthony Stephens, fantastic. Thank you so much there. I guess a reminder then, a cooking analogy is the slower the simmer is, the better that product is going to be, right? So we'll see what that slow boil looks like really at the end of the session here. Perhaps going the opposite way of that concept is we talked about this just now, just to mention, you know what? No, we'll do it later. But Sony's up 1.7% now on the back of that news. We'll talk more about that in a moment. But I think let's segue from what Anthony was just talking about there into the broader AI space in China, where you have ByteDance reportedly telling its employees that it would not use distillation as a shortcut to advance its AI models. That's even if that actually means lagging behind its peers domestically. That's according to the information here. Let's bring in Min Min Lo, our China correspondent here, to talk us through this conversation here.
Yeah, this is according to the information, and Zhang Yiming, the founder of ByteDance, had told employees in an internal meeting that the company is not going to use distillation to advance its AI models, and he says that the company has to be willing to sacrifice some short-term gains and keep their eyes on their long-term goal, because distillation is going to interfere with true indigenous long-term innovation. And of course, it doesn't help that the US has been scrutinizing these IP thefts or alleged IP thefts, with Scott Besson floating the idea of sanctions or blacklisting these Chinese companies. And of course, ByteDance has a bad experience with TikTok, right, and the legal challenge in the US. So the information is reporting that they are particularly sensitive to this and is clear about not relying on distillation. And it's coming as they're also planning to work on a 5 trillion parameter model. That's the
crazy.
Largest. Yeah, that's almost twice of what Kimi K3 is. And
what was Kimi K3 again? 2.4?
2.8 trillion.
2.8, okay.
Alibaba has a 2.41, so they're looking at 5 trillion. Very ambitious project. Some people close to the project are saying that this is a gamble by the company, and they're looking to leapfrog other competitors. And again, this is according to what other media is reporting right now.
That's very early days, though, on that project.
Yes, very
right?
early days.
Okay, Unitree IPO. That's I think today is subscription day.
Yes.
So what are we watching there?
Well, we are looking out for the data when it comes through in terms of subscription numbers. We don't have that yet, but just judging from the pricing, it's priced at 150 yuan, which, if you calculate the PE ratio, is 200 plus times, which is way above the industry average of 38 times. So that tells you the company is pretty confident, it seems, about attracting investors' interest, right? And just judging from the market chatter we are seeing on these Chinese trading platforms and social media platforms like Weibo, there is a lot of interest. Just take a look at some of these comments that are on Weibo. People are saying they're praying to the gods to give them an allotment. Some people are saying, look, a dancing robot company can command 150 yuan for their shares. That is just incredible. But some others are a little bit doubtful and are saying that this is a lot of froth. It's too expensive. They don't dare to buy it, and it's probably going to break below the IPO price after it peaks soon after listing. So a lot of interest, because as you see the video earlier, it debuted on the Shanghai Spring Festival Gala. So it's a household name. Everybody has seen it. I
remember that.
Yeah, so there's a lot of interest in this company, although, of course, yes, it's one of the few profitable companies in the robotics scene. Many are still unprofitable, but this is one of the global leaders in terms of market share. But it's still facing some headwinds, given the US government has recently banned new models of humanoid robotics from China.
Okay, Min Min, thank you so much. Our China correspondent there on Subscription Day, which is the less compelling cousin of Independence Day. Speaking of films, not Sony Pictures, I believe it was 20th Century Fox. That's the crude segue to checking shares of Sony on the back of that Nikkei report. And as you can see, has had some reaction in the markets on this joint investment, 1 trillion yen sensor plant in Kumamoto. We're going into the last 20 minutes of the morning session there in Japan. Once we hit that lunch break, will also be the time where we're getting HSBC coming on, Jing Liu, out of their global investment research team, to discuss their latest take on the economic numbers coming through out of China, latest of which was that inflation miss coming through over the weekend. She joins us at those times, well, not the times on your screens, but at in about 20 minutes or so. So stay tuned for that. Lots more ahead. This is Bloomberg. Okay, we're going into the third week of the calendar month, which means we're done with some parts of the economic indicator basket in China. We're going into things like we are in the window for credit data, number one. We are also moving into activity numbers, but we're done with as far as PMI, inflation, and trade numbers. That's the summary on your screens. And in case it's eluded you so far. As you can see, apart from exports and trade, most numbers have come in softer than expectations. And the latest one was, of course, on the weekend where you had PPI coming in below estimates of 3.9, 3.5%. CPI coming in also below estimates, median estimates, I should note, which I guess points to the fact that we are still on softer footing there. In fact, the Citi Economic Surprise Index for China coming in still in negative terrain. We have seen, of course, a gradual decline from the peak that we had in the second quarter, and that's where we are right now at negative 40 points on this specific gauge. Now, I mentioned the miss relative to the median on Chinese inflation, right? Because when you talk about that relative to the average, it actually matched the worst miss in 3 years of, I think, 0.3. Only a few economists got it correctly, including the one joining us here on set right now. HSBC getting it bang in line with forecasts on CPI. Jing is Greater China Chief Economist at HSBC Global Investment Research. So you guys got this one correctly on inflation. Softer inflation all around. Are you alarmed, or is this more or less expected in your view then?
I think it's more or less expected. For this one in particular, I think the deceleration is almost entirely attributable to the deceleration in the oil prices.
That's a good thing. Okay. Okay, yeah,
and
yes.
On top of that, I think what's probably more interesting to look at is that if we look at the core CPI, that one is more or less stable. If we look at the month-on-month change, again, the biggest drag comes from the oil prices. But the good thing is that we see there's sign of stabilization on pork prices, and altogether the food prices seem stable. Another thing I want to point out is that in China, actually, there's a pricing mechanism. NDRC adjusts the fuel prices with a certain interval. So from that perspective, probably the volatility in July is not entirely captured, which means in August we might see the inflation up again driven by the volatile oil prices.
Because that is a delayed function, is what you're saying. And as far as the NDRC, the cadence is not a daily frequency, daily update, right?
It's every 10 days they fix prices, yeah.
Understood. Now, you have a macro tracker. Put everything together for us. How do you think the economy is doing?
Well, everybody is talking about the K-shape. We certainly see the contrast of a very strong trade side and relatively weak domestic side. What's alarming to us is that the second quarter data shows that the infrastructure investment, together with other type of investment, actually basically contracted year on year. I think that's something the government can work on for the rest of the year, and we might see front-loading of some fiscal policies, and even with some possibility in late October, there might be announcement for continued operation for the local government debt swap.
Why late October? Why the timing on that?
So in the past several years, we see that late October would be the time where actually the lawmakers will gather together. They can discuss certain things.
I see. Okay.
And for this thing in particular, we might need additional quota for the debt swap. So I think that's quite important. We have seen some progress. Maybe the original quota is not enough yet to basically resolve the problem. So I guess we need some time and probably more help from the central government policy makers in order to tidy up the local government debt.
So some of more swaps then, as they, let's call it, free up more capacity to spend. Because there has been some spending friction on the local government side. Where do you think that spending goes if that does pick up?
Well, I think this is the first year of the 5-year plan. There have been already a pile of good projects piling up. A lot of people are talking about the 6 networks.
Yep.
So that will certainly be the aspect of spending, as long as the local governments are empowered to help invest together with the central government.
Speaking of the central government, I think it's the first time we're speaking with you since the Politburo meeting. What are your takeaways from that?
Well, the Politburo meeting on the surface, it looks like the top policymakers are still more or less comfortable with the current development, but it does signal there should be more counter-cyclical measures, and there's room for incremental policies. And in our view, the incremental policy might be tilt toward, as we mentioned, helping the local government rather than the direct spending support for the consumers.
Why I guess the question that arises in one part of the market is there seems to be a lack of, I wouldn't call it a lack of urgency because that does denote that there's an urgent need to spend, but why do you think it's more longer term, the focus now, than it is to shore up growth over the short term?
Right. So I think we have seen this year different kind of policy announcement regarding how to support the consumption.
Yes.
It seems like they have changed their stance from the kind of a cyclical support, like the trading program, cash handout, etc., to a more structural one. So they want to make sure people are confident about the future. They have good jobs, they have income expectation, such that they're more comfortable to spend. This is a direction to go in the longer term. They published a 15-year plan, and specifically consumption 15-year plan, and also basically how to equalize access to basic public services based on permanent residence. I think those things will take time to actually filter through. Probably within the next 5 years, we're going to see changes, but unlikely to happen within just a year.
Okay, and just short term on the property market, I think we heard from Beijing that they're looking to support additional measures to support their own property market. Where do you think we are on the housing market story there? That seems to be taking longer than expected.
Right.
Yeah.
I think overall we still don't see the national market show the clear sign of rebound yet. Probably certain markets show the bright spots, such as Shanghai, maybe Hangzhou and Shenzhen, etc. But overall, I think it's still kind of sluggish. That's probably one of the background why Beijing wants to roll out the policy, relax purchase requirement, etc. But again, I think this one sort of tie up with the local government one, because China used to have the investment-driven model between 2008 and more or less until 2020 or something. So those two used to actually borrow quite a bit, and in some cases not too sensitive to the interest rate. And that is why now China is in the middle of the transition. We see the relationship between the credit demand and the GDP growth also seem to not be so correlated as before.
Yeah, it seems that markets need to be less short-term focused on the story here. Well, I had a look at exports, for example, and that's really picked up. Markets are looking at exports as perhaps where you are getting the alpha. What's your outlook there for exports moving? I mean, does that continue to remain the pillar of growth that is most visible to markets, I guess, is the question.
I guess export will likely to stay strong, especially now U.S. and China are negotiating lowering the tariff on each side for $30 billion US dollar equivalent. So that's going to probably support not only the export, bilateral trade in particular, but also to some extent change how the supply chain is deployed. In particular, I think there are signs that certain, especially consumer goods manufacturers, are looking to reverse China plus one, meaning that if nowadays the tariff difference is narrowed, or even China is going to have a lower tariff, then they might bring some of the manufacturing back onshore.
Yeah. It's funny how quickly that story changes, right?
Yeah, and that's going to help with the final demand, because it will mean jobs being created and, et cetera, et cetera.
FDI and everything else that's coming alive. On the exchange rate, so how do we look at that now? It seems to be that it just keeps getting stronger and stronger, the Chinese currency.
Yes, actually, for the renminbi, even during the time when we see that U.S. dollar is strengthening, renminbi was strengthening since the beginning of Middle East conflict. Right. We also see renminbi being fixed on the stronger side. So it seems like the policymakers' mindset, at least not worrying about the stronger renminbi somewhere in the way for strong export. And at the same time, I think China probably increasingly will look to support outbound direct investment. And also the policymakers emphasize on balancing import-export. So from that perspective, maybe slightly stronger renminbi will help.
Okay. If you put it that way, yes, it does seem to be the case. Thank you so much, by the way, for coming here on set and taking the time there this Monday. That was Jing Liu, Greater China Chief Economist at HSBC Global Investment Research. Right, a brief look at markets. An hour into the session here. Nikkei's up 2 as we head into the lunch break there. We are gaining some momentum. 0.7% to the upside on the Hang Seng Index. We have lots more ahead. This is the China Show. Okay, we're going to do some island hopping across the sectors we're tracking. As you can see, we're starting things off with gold, and while spot price is lower right now, we are lower from 4,400. So there's a catch-up trade we're seeing here across the region. And as far as equity iterations are concerned, with the mining stocks really feeling the bounce, perhaps a lagging indicator of price itself. We're looking at Taiwanese tech as well on your screens, following the CapEx story in the U.S. We, of course, had a very good session on Friday, in case you missed that. Perhaps it did help that some of the jobs numbers are helping pare back expectations for higher rates, at least over the short term. Healthcare, Wuxi AppTech, also on your screens and also on our radar today on the back of this coming back, of course, of healthcare. We talked about the momentum within that sector actually starting to creep up in terms of market leadership. It helps that you have some of the news flow being more supportive of the Wuxi AppTech story, helping that thing along. Speaking of supportive news flow, Beijing, we talked about this multiple times on shows, in case you missed that, reintroducing some measures to help encourage home buyers there, non-residents, to participate in the rally. We're getting market reaction, very positive one on your screens. And Hyundai Heavy coming up on your screens as well, really on the back of that story there. We're up good by about 5% there in Seoul today. We're headed into the Japanese lunch break. We'll tell you about Sony coming up next. This is the China Show. All right, welcome back. Just headed into the Japanese lunch break. This, on a benchmark basis, this is your outperformer today. Nikkei's up 2. Dollar yen has been well behaved last, let's call it week or so. Asia Pacific's up 0.7%. That is thanks to what's happening in Japan, partly to some of the tech names in Taiwan, which I guess we've talked about. We'll get to later on. Sony has been in focus, and perhaps I alluded to that early on with the Taiwan glance there with TSMC. According to the Nikkei, they're set to invest, both companies there, 1 trillion yen in that sensor plant in Kumamoto. And the pop you see on your screens on an intraday is when that Nikkei report actually dropped. Okay, from that, let's have a look at where we are in Korea. So we started out well. We've lost some momentum on price. The vol story is one that has been restrictive to asset managers. I mean, if you have actual vol at 100, good luck convincing your compliance officers that that's a good idea to do. But yes, we are starting to see that pull back a little bit after a historic sell-off, flushing out some leverage trades. You have tighter regulations, of course, around that, helping curb the risky bets, and perhaps the market is somewhat responding already to that story. Joining us here on set, Sang-Mi Cha, our Asia equities reporter, to talk us through what they're seeing as far as this story is concerned.
Yes, the KOSPI that you just mentioned, it was around 100. It was pretty scary. It's now come down to the lowest in 2 months. It's still up, compared to like 28 that we have seen just earlier this year. But again, we do see this deleveraging kind of play out, right? Morgan Stanley says that we're halfway through, but of course, we can see that in margin loans that has slumped to the lowest this year, at least. It's climbing, but very slowly. And we see the KOSPI again kind of lowering after this forced liquidation in some of the retail accounts. We saw 1 trillion won that was wiped out in June, and similar amounts in July again. So after a lot of this leverage that was washed out, we do see some clear pathway. But again, it is still quite volatile still again, which is kind of making it very difficult for foreign investors to come in.
Yeah, it is still at 70. I think it's worth pointing out, right? We have come off extreme to perhaps less extreme levels there. What would it take then for foreign? Because there was, I think, 1 or 2 days when foreign institutions came in and bought the dip. That's quickly gone away. What would it take for them to continue buying into this market?
Yeah.
Then?
So one of the key metrics that we're looking at was actually the government policies, especially around the single stock leverage ETFs. And on July 31st, they raised the margin ratio for the requirements to buy into these leveraged products. And that did really help kind of ease some of that volatility. We have seen the trading volumes of some of these riskiest products actually come down significantly. But again, what would it take? They want a significant, sustainable slowdown of this volatility. They are staying constructive on the AI trade and the memory space, but they want to do that through Taiwan or other ETFs in the U.S., for instance, instead of Micron, instead of really just piling into SK Hynix and Samsung. So that's something that they're telling us right now.
Well, speaking of SK Hynix, they just announced this nearly 40B capex fab expansion. What do we know about that?
So they're building 2 fab plants, one in Cheongju and one in Yongin. These are both in Korea, and that comes after the July U.S. listing of $27 billion. This was widely expected, but what's really key right now, the focus is on the shareholder return policy from the company, right? Everybody has been expecting this to be brought a bit closer, a bit earlier than expected. And now there is chatters that they're looking at 100 trillion won worth of return framework. Maybe 60 goes to dividends, 40 trillion goes to buybacks. That would be a really big number. But of course, some say that it could be a bit lower, 70 trillion won. So these would really matter to the sustainability of the SK Hynix stock.
Yeah, but how do they give the money back, right, is the point. Thank you so much, Sang-Mi Cha there. My leading indicator of how the market does is how much rest Sang-Mi actually gets, because it's been extremely, a very extremely hardworking set of our newsroom there, the folks covering Korea. Speaking of, really, not to perhaps even add to the complication of the Korean story, is one where the currency is actually moving, if you think about it, against the grain of an economy that is just exporting tens of billions. We are now on the weaker side of the cutoff. We're weaker in the dollar across most of the EMFX currently, and as you can see, the Bloomberg Asia Dollar Index, bottom of your screens, has a touch of green there. And that really takes us into the broader conversation on central banks and how they're looking to support their various currencies in emerging Asia, increasingly beyond what you have in as far as forex reserves are concerned. For more on this, this is a fairly complicated story, but perhaps no better person to help unpack and hit the nuance here is our editor for Bloomberg Markets today, Sam Onstead, is here in town with us to talk us through this. So, well, first, nice to see you. Welcome to town. We're all yours. How does this story play out, and what are we seeing?
So I think what you're seeing very broadly is that central banks everywhere have to react to an oil price going up, an energy price going up. Sure. So in particular in countries where that is very sensitive for the economy, central banks are having to find new ways to support their currencies without deploying their FX reserves. And so you're seeing this kind of across various different places, particularly in emerging Asia. But it's actually a dynamic really that's maybe sharper here. But it's a similar dynamic that we'll be playing out for, where I come from in the UK with the Bank of England, where you have a great vulnerability to energy prices and importing inflation. And so you're starting to see that now kind of much more broadly.
Well, talk to us about specific actions that the central banks are taking, perhaps more in the spotlight now than they have been, if you think about the toolbox that they're deploying now.
Yeah, that's right, and that's a good way to think about it. So sort of going to a sort of broader toolkit beyond, whether you're going to raise or whether you're going to raise interest rates. Sure. And of course, this is also, heavily affected by the Federal Reserve and this flip that's happened over the course of the year, where, go back, if you can, cast your mind back to February, which feels like an incredibly long time ago.
Yeah, quite. Yeah, I have mind space for that, but yes, okay, I'll do that.
Yeah, where the outlook for central banks was very different to how it looks now. So, you have India, for example, kind of tapping their diaspora around the world for high yield flows. You have South Korea and Taiwan getting exporters to flip into or sell dollars and flip into local currencies. And you mentioned the one in July had its best month since 2022. So it is working, though overall these currencies still in emerging Asia lagging behind those in emerging Latin Americas. But the gap potentially could close.
And the sustainability of these strategies, how they can, and what's the risk that's building then as they deploy some of the new tools here?
Again, the risk is really the very broad one, which is we don't know when the war in the Middle East is going to end, when we're going to get a sustainable ceasefire. And until you can see that and you can get a much clearer view on where oil prices are going to land, it's very difficult, again, for any central bank to kind of decide exactly where their policy is going to lie. And so you open this toolkit up now, you make these moves now, but if that remains the case over the course of the rest of the year, that the oil prices remain, when I got up from my desk, WTI around 79, Brent around 84, 85, if they continue to go up and they don't really come back down towards the kind of low 70s level, then it becomes more and more difficult for them to do that over a sustained period of time. And then also, you have the AI story in there, particularly for South Korea and Taiwan. They need that hyperscaler story, that spending story to continue, so that the dynamics that they're using at the moment of this huge, amount of money that each of the countries are making because of TSMC and SK Hynix and Samsung, that also needs to continue. So if there's a puncture in the AI narrative, that could also switch the view.
I mean, you alluded to this. That's a good point. The fact that I can't even remember beyond Fed, but the fact that we're now counting how many hikes the Fed likely will have, as opposed to how many cuts that they would have pursued. Remind us of how a strong dollar could change just everything for these EM central banks, almost like a light switch.
Yeah, pretty much. Yeah. And certainly, so you had jobs data, at the end of last week, actually came in and sort of softened that narrative a little bit. But again, a lot of this is down to oil prices. A lot of it is down to the AI story. A lot of it is down to these huge megatrends that are overshadowing basically all of global markets. And if they continue as they are, and as you mentioned there, if the Federal Reserve does follow through on what is currently being priced by markets, the dollar strengthens, and you're right, it creates extra pressure. And then the question is the toolkit that's being deployed right now going to be big enough to tackle that?
Okay, there we go. Fairly dynamic story. Sam, fantastic. Thank you so much there. That was our Markets Today editor there with the latest on that story. Now, we just alluded to this, right? So in case you missed that soft jobs print on Friday, so the bets around September, pre and post jobs report actually coming in. There we go, right? So this is actually the expectations. And we're now, so how you read this is now we're currently at a 47% probability of a rate hike in September, and that was down. And that went into the high 30s post the jobs report. We've creeped back a little bit towards let's call it coin toss probability. But that is certainly a conversation worth having. It is a soft jobs print, but I mean the tug of higher prices and higher inflation and debt burdens is really pulling this back towards the midpoint. I guess something to watch as we go into the thick of the week here, where you have, I think it's a 10 and 30-year bond auction in the Treasury market towards the latter end of this week. Speaking of a week ahead, so it's RBA on tomorrow, Tuesday. You have, of course, the fairly consequential CPI report coming out of the U.S. On Wednesday. And, of course, here in the Asia-Pacific, we do have, of course, in Indonesia, which, by the way, last we checked, is still set for a bull market, the annual address there out of the president, Prabowo. That book ends this week for us, and what a time to be alive, really, looking at this busy week ahead on the macro front. Right, we'll table that for now. I'll look at equity markets. We're about 10 minutes into the lunch break over in Tokyo. That means we're about 70 minutes into the cash market session. We're better by 0.7 of 1%. We've been trading for the better part of the last hour or so. Lots more ahead. All right, BlackRock CIO of Global Fixed Income talks about this surprise contraction. I think we alluded to this contraction in U.S. jobs that we had from the Friday report, reflecting a productivity revolution rather than underlying economic softness or weakness. Speaking exclusively with Bloomberg, Rick Rieder says that the growth in the U.S. economy remains on track.
actually remarkable how unremarkable the data is. Listen, I think, when you look at, people say, well, gosh, we're not hiring many people because we have a supply issue. And you saw some of that play through today. But that being said, you're not seeing any wage growth. So meaning there's not that demand for labor that you would expect when you got an economy that's doing as well as it's doing. I mean, we're going to grow. I think you're going to see 6% nominal GDP. You've got corporate top line revenue that's strong. Earnings are strong. But you're seeing operating leverage for companies kick in like you read about. I mean, you look at all these earnings reports, particularly in the tech space. Companies are growing. They're spending immense amounts of CapEx. But you're actually cutting people in many cases. So anyway, I think we're seeing a productivity revolution, and I think we're watching it play out month in and month out. I mean, to have only 20,000 jobs on a 3-month moving average, you strip out healthcare, you're having negative job growth in aggregate. So anyway, I think listen, I just think we're going through. I think when they summarize this years from now, we're going to witness something that is productivity. People say it's AI kicking in. I actually think it's just been an ethos around companies growing their business and seeing how you can operate without that much employment.
Well, also, you've got the fall in immigration that is probably contributing to these big declines we're seeing in the labor force. But the people who want jobs are apparently getting jobs with unemployment at 4.1%. Totally. So I assume this tells you, as well as the Fed, that we don't have a problem with the labor force side of the mandate.
Yeah, I mean, I think that's right, Mike. I mean, I've been pretty adamant about I don't think the Fed needs to hike. And I don't think you really will solve the inflation dynamic. Part of why I think these task forces will be so powerful is you'll get into what are some complex subjects. When you break down inflation today, you look at the difference between services and goods. You think about what's still sticky in inflation, education, healthcare, insurance. Does you moving the overnight funds rate up really do much? And you get to the point being if you're restrictive on rate and you're driving mortgage rates higher, I just don't see that as really effective trying to bring inflation down. You've got what I would argue is, yeah, maybe it's an okay labor market, but you still need, in particularly when you have this much debt on the country, you need to grow faster. You need to put more people to work. And I think that to me is the philosophy that the Fed has to employ today.
And that was Rieder, of course, of BlackRock, speaking exclusively with Bloomberg. So if you want to rewatch that specific interview or others that you might have missed here, it's the Video Hub where you go to. Our subscribers can explore live streaming, news, and as we just talked about, interviews that you might have missed here. All of the programs here on Bloomberg TV, you have documentary, you have report analysis, and much, much more, of course, and everything in between. Check it out on Bloomberg.com/videos. Right, welcome back. Look at that. Juxtapose those two images on your screens, right? Live pictures of Shanghai and Hong Kong, where it was really what you're seeing in Shanghai now is what we had in Hong Kong for the better part of the last month and a half. So be careful what you wish for, right? For everyone who I haven't seen the sun in 6 weeks. We got too much of it on the weekend. On Sunday was the hottest day since records were kept. Going back nearly 150 years here in Hong Kong. So it's an extremely hot day in Hong Kong. And, of course, this Typhoon Dolphin, which has brought extremely heavy amounts of rain. As you can see in Shanghai, mass cancellations of flights. We'll get to that in a moment. It has resulted in a lot of extremely wet weather across not just this part, right? Southeast Asia had tremendous amounts of rainfall over the weekend. You just have to Google rain in Manila. And it hasn't stopped raining there, I believe, for 4 days straight now. So it's really been affected by this weather system. Recently with Typhoon, aptly named Dolphin, as we go into that conversation this Monday. It did make landfall, of course, just to note there. 2 landfalls on the weekend. Joining us here on set is Mary Hui, our weather reporter, to talk us through the threat of this cyclone. What have you seen, and what threat does it pose now?
We saw some heavy rains, strong winds, as we typically do with these typhoons. And now the next beat to look for is the ongoing rainfall threats that the cyclone, which is now a tropical storm, so it's weakened a little bit as it's tracking inland. But it's carried a lot of this moisture. It's carrying a lot of moisture that it picked up through its many days traversing the Pacific Ocean. And it's going to clash with some cooler air as it pushes up north, and that combination of that moisture and the cool air will probably trigger a lot of rain over some key agricultural regions of China, and that could be a little tricky for crops like corn, soy, and the like. So that's what I'm keeping my eye on over the next couple of days.
And, like we talked about this, the exceptional heat that we had on Sunday here in Hong Kong. Does that have to do with what we just talked about?
Totally. It's definitely a tale of contrasts. Often when there's a typhoon to the east or north of Hong Kong, it's that air that gets pushed down over our city, and it keeps the heat trapped to the ground, keeps smog pollution close to the ground, and that's why we get these hazy skies. And winds die down as well, so that's why it was so just stiflingly hot and still over the weekend. And I had to change my plans, cancel the outdoor plans, and went indoors.
Yeah, I think all the treadmills are actually full because people just had to ditch anything that they had planned. Well, I think that the point is for commodity markets, right? It's as if we report on these things as if they were unexpected, but the extreme weather situation seems to be something we need to get used to over the next, especially as we enter the thick of typhoon season here in the Asia Pacific. How are you looking at that framework?
Yeah, the tails, I think, the tails of the extremes, either very, very hot or very, very wet, are just going to become more and more frequent. And I think commodities markets, financial markets are trying to come up with more nimble, agile ways to try and hedge those risks and find and match those people who are looking to hedge them versus people looking to take them on, and see whether there is a better way to manage these risks other than waiting for the perils to happen, I guess.
Okay, fantastic. Mary, thank you so much on the weather to Mary Hui. These extremes between hot and cold that we're seeing in the region. Right, just some stories that we're tracking before we wrap up the show today. So you have more threads in case you missed that. Listed, of course, already in the mainland, is planning a listing in Hong Kong at an appropriate time. I mean, when was it otherwise? Anyway, according to a filing, the company says the move would help attract talent. More Threads has seen its shares surge more than 420% since its Shanghai debut, actually, just last year, if you think about it. It also reported a first half net loss of $1.7 million. That's down from last year, while its revenue for the period actually jumped nearly 150%. Now, Berkshire Hathaway has spent about $4.5 billion to buy back its own shares in the second quarter. Results, of course, were out the last few days or so. It also purchased nearly $20 billion of equity. Signs that CEO Greg Abel is putting more of the firm's massive cash pile is an understatement to work. Now, operating earnings climbed 16%, that's 1/6, driven in part by gains in the conglomerate's manufacturing and service and retailing divisions. Westpac is flagging caution on Australia's softening property market, with mortgage applications down about 20% since May. Now, the lender saw an unaudited net profit of $1.3 billion in the last quarter, with growth in deposits and lending helping offset weakness. CEO Anthony Miller says, of course, the housing credit growth is likely to moderate into next year. Shares are down on your screens, down about, let's call it 5% if you round things down. Okay. Energy markets, commodities are very much in focus. We've been looking at oil really for the better part of the last 6 months or so. Copper's given us something to talk about, 14,000. Hang Seng Indexes, in case you missed that announcement, is now launching this new index that tracks China copper stocks. That was, of course, just coming out there. Gold has been something we've talked about. And the momentum trade that's come back in as far as precious metals go, we're seeing that ebb a little bit. That's a verb we've been using, I think, more necessary, a lot more than necessary in the last hour or so, but it is what it is. Okay, Guotai Junan International on your screens, very nice. 36% to the upside. Take private offer. The pricing on the offer is at a 44% premium. Difference is about 8 points or so from the current pop we're seeing in the shares right now, but certainly something we'll track going into the next few days or so. And any developments around, of course, that take private offer. China Airlines on your screens. We're looking at 8.5% to the downside here. Decline in first half net income. Zhipu and Minimax on your screens. With, I think, MS coming out and upgrading their price target. And as far as Zhipu is concerned, up 1%. We're paring back after quite a massive rally, I should say, in shares of Minimax last week. And the story across the Hang Seng Index, have a look at where we are on that. 7/10 to 1%, roughly where we have been trading for the better part of the morning session so far. Dollar China is still on the stronger side of 3.5-year range. And just to mention, of course, before we wrap up the show today, big earnings coming through this week. The statistic for you the next 3 weeks is 90% of MSCI China reports. Tencent on Wednesday, Lenovo and MTR on Thursday, Huicho Maotai and Zijin on Friday. That's it from us here on Shows Today. We will see you all tomorrow. Thank you for joining us this Monday. Have a great week ahead. This is The China Show.